welcome to the podcast, everybody. Thank you for joining me. We got about an hour left, about an hour and 15 minutes left in the trading day, and the stock market a little negative today after obviously a big run since early October. And just wanted to give you a quick update on kind of what we're thinking, what we're doing. And just a reminder, eggerscapital.com if you want to go check out our site, twitter.com. At Karl Eggers is my handle. We're also on Facebook. We're on Google+. We're on iTunes. And by the way, for those of you that came to the Investor CrossFit a couple nights ago in San Antonio, thank you very much. Had a really nice crowd. And really, hopefully, y'all got a lot out of it. And very good interaction, very good questions, and getting a lot of positive feedback. So thank you for that. So let's take a look at the S&P 500. We'll start off looking at that first. So, we had the obvious breakdown below the 200-day moving average, which was right in here. And, the market had been kind of, heading up, and then it started to kind of flatten out. And meanwhile, we started to get some, signs that maybe we would go through something real small. Well, it wasn't real small. It was a very violent 4 or 5 day drop, culminating in that basically flash crash 2.0. Right, which was on that Monday where the Dow Jones fell about 1,100 points very quickly. And then we bounced back, and you kind of had the bottom fishers come in and take advantage of that. And for people that wanted to be aggressive that day, we were in there buying stuff as fast as we could. And, of course, we did get the 2 or 3 day bounce. Then we went through September and tested the lows. And it's not exact, but close enough, right? And we tested the lows. We formed that W pattern, and now we have gone off to the races. So is that it? Well, this is very reminiscent of 1998. I've been showing this picture lately. The chart's almost identical. And in 1998, the stock market did run until the end of the year. And, of course, if we look at where the end of the year is, we're right over here. Could this keep running through the end of the year? We go to new highs? Absolutely it could. Does it change the fact that the stock market is starting to or continuing to show signs of fatigue? No, it doesn't change that. And so keep that in mind, that this is all about time frames. This is all about the bigger picture. We went through, as of right now, this has been a correction, right? It was about 12 to 15%, depending on which index you looked at. Of course, there was a lot of stocks that went down 20, 30, 40%. Some of them have fallen, haven't really come back. But it was really nasty. It did a lot of damage, but it's still contained within a correction so far until proven otherwise. Having said that, if you look at some things, we'll go through some different items, but there's not a confirmation so far of this new high or getting near a new high. The internals aren't that good. In fact, they're worse now than they were, let's say, back here. So that's not good. We need to see some improvement if this is going to be a longer lasting bull market. Can it go up through, let's just call it the end of the year here, can it, zigzag and go on up through the end of the year? Sure, it could. But we have to see, things like junk bonds or high yield bonds improve. We have to see the small caps improve. We have to see the transportation stocks improve. It can't just be led by, Apple, Facebook, Amazon, Netflix, Microsoft. It can't be just led by those companies, and that's it. So we have to have some breadth to this market. But if we do kind of zoom in here and figure where we are going, I think the logical place right now for this market is if you look at the 200-day moving average, which was prior support and really had no problem getting back above it. But I think there's a logical place here is between, let's call it 2,100 and 2,000. And why do I draw that? Well, this was the box we were in before. Okay, we were in this box where we went down in it, we came up, we fell, we rallied back, and then we started to stall it. And there's a couple of days where everybody thought, this thing's going right back down, and that's it. And we blasted on through, and so now that becomes your support. So you kind of got these two distinct levels down here between, let's call it 1880 and 2000, and then now between 2000 and 2100. And we could spend some time back in here, and this becomes just a that was just a bad couple of months, right? That could be the case. We just moved sideways for a while. But certainly the stock market could pull back a little bit here. And depending on what areas you're talking about, could pull back more than others. But don't underestimate the fact that all that fear that was here in August and September is gone now. And now what you have is people wanting to fix their portfolios, and they see the market going up, and it has not let them get back in. This run from October until now has not let a lot of investors in, and so you're seeing this chasing going on, and it could push us up through the end of the year with also seasonal patterns. We went from there's some stats going around about how far below things like the 200-day moving average, the 50-day moving average. The 50 is this blue line. We went below it for good, kind of in here, and we stayed below it until here. And now we're way far above it. When you get that type of reversal like that, the numbers have been good going forward typically. We've seen a huge drop in the volatility index, I think the biggest ever. So we've got this big spike in August, and then we've come from 50 down to 13, 14. So you've gone from complacency to sheer panic, jumping off buildings, to back to complacency. Very, very strange action on the part of investors, and shows this really, really back and forth emotional battle instead of trying to round off the edges and saying, okay, I'll make some maneuvers a little towards the bearish side and some maneuvers a little towards the bullish side. People are taking extreme actions where they got out in August and they still haven't gotten back in, and then maybe they're piling back in now. That's how you get really poor results over the long term. Let's take a look at the Dow Jones, and you'll see here that kind of a similar picture. It didn't fall quite as far the second time around as the S&P did in relation to its prior low, but not real far off its high. I think at this point it's probably about 3% off of its high. Here's the issue, though. If you look at mid caps, they are still 6% off their high. Russell 2000 is about 9% off of its high. And it is constructive. You can see I've drawn this line here where we were in a downtrend, and we've kind of broken that. Next kind of resistance around this 1210 area for the Russell 2000, and then could we go up to the old highs? But we need to see that participating. If you look at emerging markets, again, a nice bounce from the bottom, about 19%, but nowhere near where it needs to be to get to the old highs. If you look at the developed markets, same picture. So it's still a matter of large U.S. companies, and if you think about what's been happening with, like I said, the Microsofts and the Facebooks and the Amazons and Netflixes, they've kept the market up. Apple, because they have a heavy weighting, and so those things have been doing fine, but we've been seeing deterioration in some other areas. Now, one of the areas we've been bullish on, we can remain bullish on, is the energy space. This is just the plain old ETF for XLE, and of course, don't pay attention to all these lines. I like to draw lines, but we have seen an improvement in that. And of course, what you're noticing here is the green line, a short moving average, crossing over the 50-day moving average, and now is that going to start crossing over the 100 and all these averages turning upward? We've seen a big move in XLE. We've also seen a big move in XOP. You can see this, what I would draw as an inverted head and shoulders here. And again, I think these things move higher. I think this is more not necessarily about supply and demand and where oil could be. I think this is mostly about post-crash dynamics and what happens. And when you get a crash like we got in oil, 110 down to 35, that is a crash, it plays out very similarly over the long run. And you can see with USO, which is the oil ETF or the surrogate, once it broke, you kind of got this, okay, it's stabilizing, and then this was all out a give up, right? Oil's going back down. It's going down to $5 a barrel. That's the way people are acting. And now you're starting to get a little stabilization. But regardless, even if oil stays, and again, this isn't the price of oil. This is USO, the ETF for oil. But if oil was to stay flat, you could still see a lot of those stocks for the next 2-3 years go up dramatically. And I think that's the important thing, is as an investment, not as a trade. Trading this is going to be difficult still. But I think as an investment, we've been averaging on the way down for some of this stuff, and we just think we're drawing a line in the sand saying we think it's a good investment for the next 2 to 3 years. If you go back and look at the prior oil crisis, look what some of those stocks did over the next 2, 3, 4, 5 years, and the returns were pretty amazing. It's no different than the .com bubble after that. Some of the good companies. Obviously, there's bad companies that'll go bankrupt in this environment. Same thing with the financials during 2008. But look what some of them did the next several years. I mean, it was dramatic. In fact, if you look at if we can go back this far, but if you look at Wells Fargo, it just pops up on the top of my head here, and we go back and look at a weekly picture, Wells Fargo was an $8 stock, guys. It's at 55. So, this is what the crash looks like, right? This is what oil companies look like right now. And, this rebounded a little quicker because it was one of the best companies. But even if it did this over the long run, a lot of these companies in the oil space are going to do well over the next, from a return standpoint. And again, that's not to say that, we're going to see oil back at $110 a barrel. But if you look at something like an Exxon, we've already seen a move up about 27%, but still off its 52-week high of about 13%. It got up to about 105 or so. Now, but this is a $68 stock, and it's no different than if you look at the Chevrons, if you look at the ConocoPhillips, all these big companies are basically, I think, investable on pullbacks, investable. So that's what we're looking at. We're also looking at the interest rates. Something interesting about interest rates. So when we saw the big panic in late August, that day where the Dow fell about 1,100 points, interest rates went down that day. But if you notice here, I'm going to switch over to TLT, which was if you want to buy Treasury bonds, look what happened that day. Spiked up, but it reversed, and I think Treasuries actually finished lower that day. Okay? Now, if you think about that, that was the day, all-out panic, right, in the stock market, but yet people weren't buying Treasury bonds. That was your first tell that perhaps people were going to sell Treasuries, and indeed they have. And if you kind of zoom out a little bit, you'll notice this 200-day moving average is starting to roll over now, and TLT is having trouble getting back above it. So we've had numerous times where it's tried to get above it here and here and here and here and here, and it's failing. So, is this going to try one more time? The moving average keeps coming down, and we ultimately fail. That means interest rates would be rising. Interest rates have been pretty much persistently rising in this environment, which has been a little strange because this has not been the place to go since August. Since August, you've lost about 3.5–4% if you own Treasury bonds, which is you wouldn't have thought that given what the stock market had done. We already talked about VIX. Let's look at gold real quick. Guys, I don't know what to tell you about gold. This is really, really messy. Gold's been down something like 16 out of the last 18 days. So it's got to be due for some type of short-term rally, I would think. But when you look at this picture here, what's happening is every time it reaches the bottom end of this down channel, which it's been in for a while, you get a rally, right? We got this rally. We got this rally. We got this rally. Unfortunately, this one didn't take you back up to the top of here, and it's failed. That may be telling you that we could be heading and breaking the channel on the downside. So, gold is just very, very difficult right now, and we don't have any in any of our model portfolios. I've been kind of, thinking about buying it, looking at some of the charts, but every time it gets going and you start getting a little bit of momentum here, look, this was a nice little breakout here. And from that time, from mid-October until now, it's down 7.5%, which is a big move for gold. And obviously that's because the dollar is having a good time going up since mid-October, and it's about to break out, you can see. So if that breaks out, you'll see more pressure on gold. And there's been some days where gold and oil have been moving differently from one another, which has been interesting to watch. But overall, again, been adding some things throughout this time, not really selling a whole bunch. I did mention that we did sell once we had this drop. Some of our longer-term indicators were telling us we needed to be out. We didn't want to do it at that time. So after we got the initial pop, we lightened up. Of course, the market went down after that. It's come back, and we've added some of that back. And if it pulled back a little bit and we stabilized, we would add a little more back. So, but I just want to, there's time frames here. For the rest of the year, I think things could continue to run. However, if we don't see improvement, this could be the start of a longer-term downtrend. And I want to caution you, that doesn't mean a financial crisis like '08. This is, I think that's what people are expecting if we get a drop. It's possible the old breakout level here, let's call it 1560 or so on the S&P. What if that was support? could we see something where the S&P dropped to 20% down to here over time, and we bounced around in here? It could do that. And so I think that's, your first support's this old, these kind of lows we went to back in a year ago, October, and then here recently, August and September of this year, which is around 1873. That's kind of your first line in the sand, which is basically right there. Okay, so we could fall back to there. A lot of people would be devastated if that was the case, but if we don't break out to new highs, we start all of a sudden now you're making lower highs. You need to prepare. What does that look like going into 2016? So start thinking ahead right now. But if you sold down here and everybody else was panicking, that's not the best thing to do. And you've seen why. It's because when the panic gets that high, the coming back, the stock market rallying back, the move's violent back, and that's what we've seen. So, all right, guys, thank you very much. Don't forget to tune into our radio show every Saturday. It's now at 9 a.m. Central Standard Time. If you're in the South Texas area, it's on AM 930. If you're streaming, you can do that on the website am930theanswer.com. If you want the archives, eggerscapital.com. And, of course, all the archives of the show are on our website as well. And we thank you for your feedback. If you want to email me, Karl, Karl, at eggerscapital.com. Have a good rest of your evening. Talk to you soon.